You are not broke, you have a job, you pay your bills, but at the end of every month, there is almost nothing left, and you cannot figure out why. That is the invisible drain. It is not one big mistake. It is 8 small habits that bleed you quietly month after month. And the worst part? Most of them feel completely normal. These are not the habits you read about in basic budgeting articles. No one is going to tell you to stop buying coffee. These are the middle-class traps, the ones that feel responsible, even smart, while they quietly drain your account every single month. I'm going to name all 8. Some of them are going to feel uncomfortable because you will recognize yourself in them. That is fine. Recognition is the first step. Let us get into it. Habit 1 is lifestyle inflation, and it is disguised as progress. Every time you earn more, your spending rises to match it. You got a raise, you upgraded your car, you moved to a bigger apartment, you started eating out more, you told yourself you deserved it, and maybe you did. The problem is not that you spent some of it. The problem is that you spent almost all of it. But here is what actually happened. Your income went up by $500 a month. Your expenses went up by $480. Your actual financial progress? $20. You worked harder, earned more, and ended the year in nearly the same position. A study from the National Bureau of Economic Research found that workers spend the majority of every pay increase within the same year they receive it. The raise came, the raise left, and nothing changed. The fix is not complicated. Every time your income increases, commit at least half of that increase to savings or debt before it ever touches your lifestyle. More income does not fix the paycheck-to-paycheck cycle. Keeping a gap between income and spending does. Habit 2 is convenient spending, and it is the most underestimated drain in a middle-class budget. Think about your last month. Delivery fees on top of delivery fees, subscription boxes arriving that you barely open, a premium app you use occasionally, a gym membership billed automatically while you work out maybe twice, a streaming service you keep meaning to cancel, but the cancellation screen is just annoying enough that you put it off another month. None of these feel expensive individually. $5 here, $12 there. But stack them together and the number's almost always shocking when you finally write it down. The average American household spends over $230 a month on subscriptions alone, according to research by C+R Research, and most people underestimate that number by about 80%. Convenience is not the problem. Unconscious convenient spending is. Audit it once. Cut what you cannot name without checking your bank statement. Benjamin Franklin said it best. Beware of little expenses. A small leak will sink a great ship. Habit 3 is using your credit card as a budget buffer. You use it for everything, pay off most of it, but carry a small balance. Every month, a little more rolls over. This feels manageable. You tell yourself you will clear it next month, but next month comes, something else comes up, and the balance creeps upward again. This is not a cash flow tool. This is a slow leak. The moment you carry a balance, you are paying interest on every dollar you spend, even on things you already consumed. That meal from 2 months ago is still costing you money today. Federal Reserve data shows that the average interest rate on credit card balances in the United States now sits above 20%. At that rate, a $2,000 balance costs you over $400 a year in interest alone, just to stand still. Credit cards are a tool. Rewards, convenience, purchase protection, all real benefits. Carrying a balance turns that tool into a trap. Habit 4 is over-insuring. Paying for coverage on things that do not need it. And this one surprises most people. Extended warranties on electronics, credit card payment protection plans, phone insurance on a 2-year-old model. Rental car coverage you already have on your main policy. These products are sold at the point of purchase when your guard is down and the upsell feels minor. But they compound, and many of them are almost never claimed. Consumer Reports has found repeatedly that extended warranties on most electronics represent poor value. Retailers push them precisely because the profit margins on these policies are enormous. Insure things you cannot afford to replace. Self-insure everything else. Every payment protection plan you skip is money staying in your pocket. Habit 5 is anchoring your spending to the most expensive people around you. Your reference point for what is normal is probably the highest earner in your circle. Your colleague just renovated their kitchen, your friend bought a new SUV. Your neighbor is taking the family to Europe, And quietly, almost without noticing, you start matching that pace. You upgrade your holiday, you redo the living room, you justify it because everyone around you seems to be doing the same. You do not know their income, you do not know their debt load, you do not know whether they are financing all of it on terms that are quietly destroying them. You only see the result. The research on social comparison is consistent. People reliably overestimate the financial health of those around them and underestimate their own relative position. That confident exterior and that new renovation are not evidence of financial security. They may be evidence of the exact opposite. Stop competing with a story you only know the highlight reel of. The most financially secure people in your circle are almost never the most visible. As Morgan Housel put it, spending money to show people how much money you have is the fastest way to have less money. Habit 6 is treating your home equity like a savings account. And it is one of the more dangerous things middle-class households do. This shows up as taking a home equity line to fund a renovation, to consolidate debt that you then run back up on the credit card, to pay for a holiday, to invest in something you read about online. It feels responsible because the asset is real, the house is real, the value is real. But now you have converted a safe, fixed position into a variable liability. Your home, the one asset most middle-class families actually own outright over time, is now collateral for spending. If property values drop or your income interrupts, you're exposed on multiple fronts simultaneously. You still owe the line, you still owe the mortgage, and the buffer you thought you had has become another bill. Equity is not savings, it is locked value. Treat it accordingly. Habit 7 is saving in the wrong direction. Putting away whatever's left at the end of the month instead of the start. You earn your income, you pay your bills, you spend through the month, and then at the end, if anything remains, you save it. The problem is something almost never remains. There is always something. A car repair, a birthday, a grocery run that went over, a bill you forgot. Spending expands to fill the available space. Every behavioral finance study confirms this. If the money is accessible, it gets spent. Not because you are irresponsible, because you are human. Willpower does not work against automatic spending patterns. Structure does. The only reliable solution is to save before you spend. Move money to savings the same day your income arrives. Automate it so there is no decision to make. Then live on what is left. This single change restructures your entire relationship with money. Pay yourself first. Every other priority comes second. Habit 8 is avoiding your numbers, and it is the one that locks all the other habits in place. You roughly know your income, you roughly know your fixed expenses, but you do not know exactly where the rest goes. And you do not look, because looking feels like confronting something you are not ready for. So you keep things vague. Vague feels safer. Financial avoidance is one of the most well-documented patterns in personal finance research. People delay checking accounts, avoid opening statements, and estimate their spending in ways that consistently understate the problem. The avoidance reduces short-term anxiety. Long-term, it makes everything worse. But the numbers are not the enemy. The numbers are the map. Without the map, you are navigating blind, and you will keep ending up in the same place, wondering why the destination never changes. Sit with the numbers, all of them, even the uncomfortable ones. You cannot fix what you refuse to see. 8 habits. None of them dramatic, all of them expensive. The invisible drain does not announce itself. There is no single moment where you made a terrible decision. It is just a slow, quiet bleed. Month after month, while you work hard and wonder why the numbers never improve. Now you know what to look for. Pick one habit from this list, just one, and address it this week, not next month, not when things settle down. This week, one change, done consistently, is worth more than 8 changes done once and abandoned. If this gave you something to think about, hit subscribe.